Now, we were talking in, I guess, what we would call part one of this mortgage interest as a deduction, and I used an example of a dentist making his $200,000 mortgage deductible. Well, sometimes, and I did publish this in an edition of the Ontario Dentist magazine, and it was sort of fun because all sorts of people came back and said, well, that's un-Canadian, you don't do that, but it makes so much difference. If I used my own mortgage as an example, I would use the fact that I had a $500,000 mortgage, and it took me a couple of years with the help of the Greater Vancouver Community Credit Union and Richard Rodarty, who's the manager there, who figured it out with me. And we just took all the money that came in from my tax practice and paid it down. We started off with a $500,000, I think it was $503,000 actually, line of credit here in two pieces. And that $503,000 line of credit, every time money came in, I paid it against it. And when I needed money to pay business expenses, I borrowed it on another line of credit. And all that happened is the total lines of credit kept on being, because this I was given a credit line of $500,000, give or take a couple of bucks, and that one I was allowed to use, and as long as the two pieces didn't exceed $500,000, I was okay. So when money came in that I used for personal purposes, like buying groceries or paying for the kids' tuition at school, or a birthday present or a Christmas present for the kids and so on, I didn't borrow the money for that. That just came out of money that came into the practice. But when I needed money to pay my assistants, David Holroyd or Jillian Bryan or George Aurora or anybody, I borrowed the money to pay them because that was a business expense. And it took a couple of years, but 2 years later, the money is now deductible for sure. And the reason, of course, that I suddenly had a mortgage on a house that I'd only paid $42,000 for in the first place was I'd gone through a $5 million bankruptcy and I'll call it $1 million divorce. And to settle all this stuff, I ended up with a $500,000 debt on a house that had been paid for. Nothing unusual about that. People end up in hassles on a regular basis, and it's just the kind of thing that happens in our lives. We have to be prepared to look after it. But again, in my case, it's even crazier because with the $500,000 mortgage, which today is 4%, but let's pretend it's 5% because it was 6% at one point, and 5, 4, went down to 3, back up to 4. Let's make it 5% is something that you can understand, because 5.1% is a pretty common rate in the United States right now. And this process works in the States as well, where the state limits the ordinary interest as a deduction to the purchase price of the house, which in my case would have been $42,000. But if you borrow it for business, there's no limitation. So it can work for you in the States as well as Canada. But we're really talking Canada here. So some of the people said in the Ontario Dental Association, and I wrote an article in BC Business Magazine, and people said, that's illegal, you can't do that. And at a seminar put on by Fred Snyder in White Rock in December, we had a whole bunch of people in the room that said, oh, they've been told by their banker, their mortgage broker, or even their accountant that it was illegal to deduct mortgage interest in Canada. And I want to make sure that you absolutely understand that it is not illegal to deduct mortgage interest in Canada. So I'm going to give you a quick rundown of some tax cases. We should call this one, I guess on YouTube, we should call this tax cases that prove you can make mortgage interest deductible in Canada.